Okay, welcome again, students, or learner fellow comrades. Remember, if you're new to the channel, you can subscribe and also share to other students so that they can benefit. You can find me on YouTube as Mr. M.Patrick. I was promised earlier that when we are starting this, we are going to simplify the accounts and also to make sure that our learning is very comfortable where we are. We can learn this even where you are working or even in your office, and also even where even if you cannot make it to class, you can just follow this and your studies will be easier for you. Good. Now, direct to the point today. The other day, I uploaded a video that I did an introduction to financial accounting, where I've combined from introduction, I've tackled the introduction part of it, the definition. I've looked into the objectives of accounting. I looked into uses of financial accounting. I looked into the concepts of accounting, and I also able to look into the qualities of good financial accounting. Good. So I was able to compress that into one video, which you can have also use of it. I will come up with the questions that we expect in that area for us to continue revising on the same. But today, now I want us to look into recording business transaction. Recording now business transaction. Recording business transaction. Recording business transaction. Business transaction. Good. Recording business transaction. I think we'll look deeply into recording. We say it is an act that is carried out by an accountant in the business, and the accountant not only record anything in the business, but only records those activities that we attach monetary value, that has got monetary taste, you see. And we had mentioned a business transaction. We said we have to, there are various types of business transaction can take place in the business. And we were able to say that one, you can have a categorized into two. Under that, maybe we have a cash transaction, which we said you buy goods in the, maybe you buy the goods, the customer come and buy the goods in the business and pay on cash, or us, the business, we can go and buy goods from our suppliers and we come and buy and pay on cash, pay on spot, or pay on spot. That is cash transactions or business transaction. Maybe when we are doing the acquisition of assets and all that. But we also have credit transaction or credit transaction that take place in the business, where we said maybe, let's say, customers come to us and buy goods and pay for us at a later date. This one's we call a credit transaction. A credit transaction. And even us, when suppliers supply goods to us and we pay them at a later date, that one we call it a business, a credit transaction. A credit transaction. Okay. Before now we go to know how we record and what type of recording we do, we have to understand that a business can be set up in following ways. A business, when you are starting a business can set up, business setup. When you are coming up with a business can be set up in the following way. One, the owner supplying all the resources. You can realize the owner of the business can supply. Owner here supplying all, owner supplying all the resources. All the resources. So here the owner decides and give everything. There's nobody else coming maybe to put in maybe the assets and all, no, everything that is in the business is of the owner. So that business will stand for that owner alone. Here, the owner has supplied everything in the business, all the assets, all the liability, all the assets, not even the liability, all the assets in the business is for the owner. Two, a business can also be set up in a way that the owner supplying some of the resources. Here, owner supplying some of the resources, some of resources, and rest being supplied by outside party, and rest being supplied by outside party. Good. So you realize, yes, the owner will contribute capital to the business. The owner will contribute capital to the business. But at the same time, there is other outside parties, maybe like, say, the bank. The bank can give us even the capital to run the business. Now that one will maybe in form of loan. It will give us in form of loan. That one will put it under liabilities. The owner, now we say the assets. Then the assets plus now the liabilities from the outside party now will make up a business, and also to do what? To run. So we can get a question here that maybe state 2 ways in which a business can be set up. 2 ways in which a business can be set up. You can get an example like a question type example like question like that. State 2 ways in which a business can be set up. 1, owner supplying all the resources to the business. That is 1. 2, the owner supplying some of the resources to the business and the rest being supplied by the outside party. And I've give an example of maybe the liabilities, or the liabilities, that is the obligation maybe from the outside parties, where we are going to pay them maybe at a later maybe period of time. Good. So we have to know now this. So you can say NB. We have to realize that now NB, as we are now proceeding to know how to discuss, to record this, we have to know that resources in the business are called assets. These resources that are in the business, yes, they are called assets, and resources supplied by the owner are called capital. Good. So that means we are now introducing something called accounting equation. Accounting equation is going to help us in recording business transaction. Accounting equation. And in accounting equation, here we say we have assets. Assets is equals to capital plus liabilities. Capital plus liabilities. So those are the assets is equals to capital plus liabilities. At the end of the day, the business will always stand here. All the business operate in this category. At any given time, there must be assets. Either these assets supplied by the owner, or they are supplied by the outside party. That is maybe the capital. The capital now becomes maybe the owner's supply to the business. The outside party can give us, maybe can stand under that liabilities, where maybe here you'll get bank and all that. We are going to look into that deeply. We are going to digest the equation one by one. Good. Let us start with the assets. What are assets in the business? Assets. So part A of that. Let us solve that. So here you'll say these are resources controlled by the business entity. These are resources controlled by the business entity. Resources controlled by the business entity as a result of past events. For which economic benefit are expected to flow to the business. So here, the assets, these are resources. They are resources controlled by the business entity or firm in which at the end of the day, in which they expect economic benefit or benefit to flow. There they will require inflow, economic benefit, economic benefit to flow into the business. Here there's inflow into the business. So here there's inflow. There's inflow in the business. These are resources that are in the business. At the end of the day, they are going to make something to come in the business. Something is going to flow into the business. We are going to get something into the business, the assets. You know, those are the assets. And we always categorize the assets into two. We have fixed assets. We have fixed assets. So assets, they are categorized into two. Assets, these ones here, they are categorized into two. Categorized into two, where we have one, we have fixed assets. We have fixed assets. We have fixed assets, whereby we normally say the fixed assets in this case, you know, we expect, yes, or you can call it another name for fixed asset. We normally say you can call them non-current assets, or you can call them non-current assets. Non-current assets. Non-current asset, for this case, these ones, they are acquired by the business. They are acquired by the business, and we realize that they are there. They are there just to help to acquire revenue. They are there to acquire revenue. They assist. You can say they assist in acquiring revenue to the business. In acquiring revenue to the business, but not for resale. But not for resale. We don't expect to resell or to do sell or to sell them at any given point. Maybe in future, but they are not purposely. They are not for resale immediately. They are there to assist in acquiring revenue to the business. That's why they are called non-current asset, and they are normally expected. They are normally expected to be in the business for more than 1 year. They are expected to be there. Expected to be there maybe for 1 year. The non-current assets, they are always expected to be there for more than 1 year. That's why we are saying we are not going to resell them at any given, maybe any soon. No, we are going to be there with them so that we can use them in production. We can use them maybe in storing a goods, all that in producing the goods, because the aim of us acquiring them in the farm, we want what? We want them to assist us to generate revenue in the business. So the question is, what are the examples? What are the examples of these non-current assets? Examples. So examples, now you realize, one, we have land and building. We have land and building. Land and building. You see, land is there, building is there, just fixed, permanent, to assist us in doing what? Production and all that. So that we can do what? We can generate revenue to the business. We can generate revenue to the business. We have plant and machinery. Plant and machinery. Plant and machinery. We buy machinery, big machineries used in the production, you know, so that we can store them there to assist us in producing goods and going to sell outside, so that we can earn profit. We have fixtures, furniture. Here we have fixtures, furniture, fixtures, furniture, fittings and equipment. Fittings and equipment. All this, They are there. These furnitures, everything, they are there to assist us. We are not buying this purposely not for resale. No, they are there to stay with us even for more than 1 year, so that we can generate revenue to the business. And then we have motor vehicle. We have motor vehicle. We have motor vehicles. Motor vehicles, so that they can help us in maybe delivery of the goods that have been produced in the business, that have been produced in the farm, and sell them, be transported to the final consumers outside the business, so that we can earn profit. So the key term here, one, fixed assets. They are there to assist in acquiring revenue, and we are not here for doing what? For resale. We are not going for, not for resale. Not here, not for resale. Not for resale. They are there to assist in acquiring the revenue to the farm, and not for resale. And we expect them to be there for a period of more than 1 year. Then the examples I've given: land and buildings, plant and machinery, fixtures and fittings, motor vehicles. Motor vehicles. Good. You can see I've arranged them in a way that I think this one I will touch when I'm dealing with the formats of a balance sheet. When I'm dealing with the format of the balance sheet. When I'm dealing with the format of the balance sheet. I will tell you that when you are recording now this non-current assets or fixed assets in that balance sheet, you will start always with the land and building. Why? The way I've just arranged them, I've arranged them in that with a reason. Why? We arrange them in the order of permanence. Even in the balance sheet. This is where students miss a mark. You just start with the motor vehicle. No, arrange them in that order of permanence. That order we call it. This one we can say we have arranged in the order of. We arrange always when you are naming this non-current asset. It's better to show that you have gone in the class of accounting. You arrange them in the order of permanence. Permanence. Why do I say this? Permanence in a way that you start with the one that you expect to be in the business for a long period compared to the other. Let's say compare land and building compared to motor vehicle. You see, land and building, it is a permanent thing that you will be in the business. But motor vehicle, I can be with it maybe for 1 year and then resell. But still, land and building, it will be there. The same to plant and machinery compared to fixtures and fittings and furniture. So you start with the one you see it will be there for long period as you go down. That is the good way of showing that you are an accounting student. You arrange always in the order of permanence. But more in detail, we are going to get it in the when we are preparing the balance sheet. We are preparing the balance sheet or the financial position. The financial position. And we will always be guided by the accounting equation. That's why we are digesting it. We are digesting it here. So when somebody asks you assets, give them the definition, give them the categories, how they are. It is arranged divided into 2 categories, the fixed asset. Now we want to look into what? We want to look into the current asset. Current asset. We have seen the fixed asset. Let us now see the current assets. We are still on the assets. We are still on the assets. So let us see the current asset, another category. Current assets. Good. Let us see the current assets. So that is part B. So we have current assets. Current assets. Current assets. Good. The current assets, we always say that they are most related to trading activities. These are goods or they are purchased or they are acquired by the firm purposely for trading activities. Trading activities. Trading activities. The current assets, they are acquired by the firm purposely for trading activities. Trading activities of the firm. And not expected to last for more than 1 year. Not expected. Not expected. Not expected to last for more than 1 year. Good. You see, the fixed assets, they are expected to be there for more than 1 year. The current assets, they are not expected to be there for more than 1 year. And this one, they are required to do what? Purposely for trading activities and for resale. And for resale. Good. For resale. You see? So you see the difference. Good. So these ones, they are there just to help in generating capital revenue to the business. But one, they are there to do what? For trading activities, and also what? To not expected to last for more than 1 year. What are the examples? One, what do you normally buy for trading activities? One, we buy what? We buy stock of goods. We buy stock of goods. Stock of goods. Stock of goods. We buy stock of goods. Two, we also do what? We deal with the we have debtors. We have debtors. Debtors, or you can call them trade. You can call them trade debtors, or we can call them trade receivables or account receivables. Good. Account receivable or account receivables. Another name for debtors. Debtors, receivables. So debtors are these are the people who come and buy goods on us, from us, and they will pay us at a later date. Good. Debtors. Then we have cash at bank. Cash at bank. Cash at bank is under current assets. Cash at bank. Cash at bank. The cash that we have in bank, it's categorized under current assets. Cash at bank. Then we have cash in hand. We have cash in hand. We have cash in hand. Cash in hand. Cash in hand. Good. So you realize these examples, these are goods that are there in the business to run the business from time to time, involving in trading activities. So the stock, we have purchased the stock so that we can resell. We deal with the debtors. They come and buy goods and they pay us at a later date. Good. We have the cash at bank, because that cash at bank we can go use it to sell, to buy other goods, or to engage in other activities of trading activities. Cash in hand also we can use it in trading activities from time to time. Good. So that is the how assets they are. So when you hear the word assets, let it not be something big. It's just simply that way. Things that helps the resources that are owned by the business to help them in generating revenue to the firm or to the entity. Good. We are still on the accounting equation. And the accounting equation we have said is assets. Assets is equals to capital. Capital plus liabilities. Capital plus liabilities. Good. Capital plus liabilities. Good. So let us look into liabilities now. Part B. Part B, let us look into liabilities. Liabilities, in this case, is very easy also. Liabilities, we say, remember, I started by saying the business can be set up either the owner supplying goods or the resources, or those are the assets, or also it can be supported by the outside party. Good. So here the liabilities, we say these are the obligations, the business, obligation of the business, obligations of the business that we expect to expect the outflow of amounts from the firm. That are expected outflow from the amount of the firm, from the firm. In short, these are the obligations. Obligations the business have. Obligations the business have by the outside party. Outside party, e.g. banks, suppliers, that is the creditors, you see, outside parties, because outside parties and because of the obligations, at the end of the day, there will be economic outflow. Outflow in which way? Because we have to pay them. We'll have to pay them. You remember the assets, there is economic inflow, but this one, outflow. At the end of the day, maybe after 1 year or 1 or 2 months, or depending on the agreement, you'll have to pay. So that it will result in economic outflow from the business. Good. So those are the liabilities. the liabilities. Good. So you realize it's also classified into two. Liabilities are classified into two. Are classified into two. Are classified into two. One, we have non-current liabilities. Non-current liabilities. Non-current liabilities. Non-current liabilities, or somebody can call them long-term liabilities. Long-term liabilities. Long-term liabilities. Long-term liabilities. Long-term liabilities. Good. So here they are expected to last or to be paid after 1 year. This one you will always pay out of the business, may be paid, expected to be paid after 1 year. After 1 year. And the example of this is always let's say loan from the bank, e.g. loan from the bank. Loan from the bank. Loan from the bank is one of the category under long-term liability, because we, at the end of the day, it will result, we have to pay out, and we can pay out maybe after 1 year. So example is loan from the bank. Loan from the bank. Good. Another category of liabilities, we have two current liabilities. Current liabilities. Current liabilities. Current liabilities, one, here it lasts for a period of less than 1 year. It lasts for a period of less than 1 year. Less than 1 year. Less than 1 year. Or we are expected to pay after, maybe it is not, you have to pay not less more than 1 year. So you are supposed to pay within 1 year. You are supposed to pay within 1 year. You are supposed to pay within 1 year. Good. So one, we always have creditors. 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 Another name we not always call them accounts payable, or you can call them accounts payable. Accounts payable. Accounts payable. Accounts payable. Those are another name for creditors. So if you have been asked to give the examples of current liabilities, one, we have creditors or accounts payable. These are just suppliers. They have supplied you goods, and you have agreed after 1 month, if I sell these goods, I will have to pay back. These are called accounts payable. Good. You agree on a certain period of time, but it cannot go beyond 1 year. Good. We have bank overdraft. Bank overdraft is also another bank overdraft. Bank overdraft. Bank overdraft. Okay. Amounts are advanced. Maybe let's say for those who are taking maybe advance salary advance. This comes under a bank overdraft. This is just an agreement you with the bank that you are going to withdraw amount more than the ones that are in your bank, so that you'll pay it within maybe a period of one month or a short period of time. You're going to pay maybe after 3 months, or maybe, but it won't go beyond more than 1 month, more than 1 year. So this is just an agreement you with the bank that you're going to withdraw certain amount from the bank that is not exactly the amount in your bank. So e.g. I've just given you the, let's say we have the Fuliza comes under bank overdraft. We have the salary advance, it comes under bank overdraft. It's just matter of agreement you with the bank, agreement between you with the bank. Good. So we have remained with the capital. Part 3 on that accounting equation, we have remained with the capital. Capital. Another name for capital, I always say you can call it equity. Equity. And if you are asked to define this, you just say this residual amount on the owner's interest in the firm after deducting liabilities from the assets. After deducting liabilities from the assets. anything, the residual amount you remain in the firm. The residual amount after you have now paid out the obligation that is on to the business, you have paid out now, and you have deducted from the assets. Now you realize it will be what? It will be your capital you have at the hand at the moment. Now that tells us now, if you come to this equation here, accounting equation, if you want to find capital, if this liability comes this side, you know, that's why we are saying you deduct from the assets. We say capital now will become, capital here will be now equals to, now if liability comes this side, remember it has a positive sign, it will be minus, now it will be assets, it will be assets minus liabilities. So that's why I'm defining capital as the residual amount, residual meaning the remaining, the residual, remaining amount in the business after you have deducted all the liabilities, all deducting after remaining amount after deducting assets, after deducting liabilities, after deducting liabilities from assets, after deducting liabilities from assets. So that is it. So that means we have now done the accounting equation. We have digested it very well. So now what is remaining is us to come and now do the recordings now. We are now coming to record the recordings in our balance sheet. For us to determine the financial position. Or statement of financial position. Good. So that marks the end of the lesson today. Meaning when we come next time, we are going direct to the balance sheet, the format, and then we've solved. Then we see also, we do some calculation if you have the assets in the business and the liabilities to determine the capital and all that. So that means next time, make sure you have the calculator with you and everything, because it will now involve, we are starting to get into calculation. Good. So that said, subscribe to the channel, share the video to others, refer them to the channel so that they can also benefit. We are just now heading to better future which is ahead of us. I wish you all the best. May God bless you as we continue learning. Bye-bye.